The global equity market today is valued at more than $110 trillion. That is larger than the combined GDP of every nation on Earth, except the United States. And yet, a single private decision made by a handful of individuals can quietly redirect more capital than entire countries control. This is not speculation. This is arithmetic. When people at the very top of the financial hierarchy change direction, markets do not debate it. Markets follow it. Not immediately, not loudly, but inevitably. And that is why what happened recently does not signal a possibility that IT signals a process. Not might will. Because the most dangerous phase of any financial cycle is not collapse. That IT is the moment just before collapse, when nothing appears wrong, and those with the best information begin to leave. Quietly. There was no emergency announcement that NO press conference, that NO warning issued to the public. Instead, the shift was embedded inside routine filings, portfolio reallocations, and structural changes that most investors never read, and even fewer understand. Mainstream media ignored it. Market commentary dismissed it. Optimism continued uninterrupted. But history is very clear about one thing. The end of a cycle never announces itself. It moves first through silence. What you are seeing now is not random portfolio management, that IT is not personal preference, that IT is not tax planning. It is a pattern that has appeared at the late stage of every major financial era. Roman, Dutch, British, and American. The names change, the assets change, the sequence does not. Those closest to capital flows always move first. Those dependent on narratives always move last. And by the time the public becomes aware, the outcome is already locked in. Here is the uncomfortable truth. If you are hearing about this shift now, you are already behind it. Not because you are uninformed, but because information is released after positioning is complete. That is how power functions in financial systems. This documentary will not offer predictions, that IT will not offer reassurance, and it will not offer comfort. Instead, it will expose a repeatable, multi-stage mechanism that governs how capital behaves when a system approaches stress. A mechanism that begins with quiet exits by insiders, then spreads through institutions, then reaches markets, and only at the very end reaches headlines. By the end of this report, you will understand the sequence. You will recognize the stages. You will see where we are now. And you will understand why some people will emerge intact, while others will not even understand what happened. There are only two positions in moments like this. Those who recognize the pattern, and those who become its outcome. What follows is not opinion, that IT is not theory. It is historical repetition under modern conditions. And the pattern is already in motion. Capital realignment sequence history does not repeat. It rhymes. But the sequence remains. Across empires, markets, and monetary regimes, capital follows a predictable path as systems mature, peak, and destabilize. That path unfolds in 5 stages. We are now deep into the 4th. Concentration. Every cycle begins with growth. Growth leads to efficiency. Efficiency leads to concentration. Capital pools into fewer companies, fewer sectors, fewer hands. Innovation narratives dominate. Productivity gains appear permanent. Risk feels distant. At this stage, wealth inequality accelerates not as a social issue, but as a mechanical outcome. The top 1% controls an expanding share of assets. Returns compound upward. Market leadership narrows. This is not failure. This is success reaching saturation. The public mistakes this phase for stability. They do not see fragility because prices are rising. But internally, the system becomes brittle. Rome experienced this during its late Republican expansion. Britain during its industrial and colonial apex. The United States during late cycle financialization. Capital becomes highly efficient and therefore highly sensitive. Leverage and optimization once growth slows. Leverage replaces innovation. Debt expands faster than income. Financial engineering replaces real expansion. Returns are no longer earned. They are manufactured. Corporations borrow to buy back shares. Governments borrow to sustain promises. Households borrow to maintain lifestyles. At this stage, balance sheets look strong until rates rise. This phase always feels permanent. It never is. In late Roman times, debasement replaced conquest. In Britain, debt replaced trade surpluses. In the modern era, liquidity replaces productivity. Media celebrates resilience. Economists rename risk. The public does not notice the shift because nothing has broken yet. Insider reallocation, this is the silent stage. The most important stage. Those with full visibility, corporate leaders, large asset allocators, system insiders, stop maximizing returns. They start preserving optionality. Cash balances increase. Exposure narrows. Liquidity becomes a strategic asset. They do not exit markets all at once. They rotate. They rebalance. They reduce fragility. Publicly, nothing changes. Privately, everything does. This stage is invisible by design. It occurred in 1928, in 2006, in every historical unwind. Those who control capital do not warn. They reposition. Narrative divergence, this is where we are now. Prices remain elevated. Confidence remains high. Participation remains broad. But behavior diverges. Retail investors increase exposure. Institutions reduce risk. Media amplifies optimism. Capital quietly withdraws. This creates a dangerous asymmetry. The system appears strong precisely because selling pressure is absorbed by belief. History shows this clearly. In 2007, housing prices peaked while lending standards collapsed. In 1929, stocks rallied as insiders exited. In late empires, luxury consumption rose while reserves fell. Narratives lag reality. Always. Mechanical breakdown, this stage is never caused by fear. It is caused by math. Debt meets rates. Liquidity meets stress. Correlation meets leverage. Something small fails. Then something important. Then everything reprices. This stage does not require panic. Only absence of support. And by the time the public reacts, the sequence is complete. Why this is misread every time? Because humans are narrative-driven. Media responds to prices, not positioning. Politicians respond to sentiment, not flows. Economists respond to models, not incentives. But capital responds only to risk. This is not malicious. It is rational. The mistake is believing rational behavior will be announced. It never is. The present moment, we are not at the beginning. We are not at the end. We are in the late divergence phase. Liquidity is tightening. Debt servicing costs are rising. Asset valuations assume perfection. Meanwhile, those with the most information are increasing flexibility, not exposure. History has already answered what comes next. The only unknown is who recognizes it in time. Every financial system reaches a point where momentum replaces structure. At first, this feels like strength. Growth appears self-sustaining. Confidence appears permanent. But history shows that this phase is not strength. It is exposure. The final stage of a cycle does not announce itself with sirens or collapses. It announces itself with silence, with the absence of concern from those who should be most concerned. That is where we are now. This stage always arrives after insiders have already moved, after capital has already repositioned, after the risk has already been transferred downward. By the time the public becomes aware, the question is no longer if the system will adjust, but who will absorb the adjustment. Most people miss this phase because it does not look like danger. Employment remains stable. Markets remain elevated. Innovation narratives remain loud. But beneath the surface, the structure has already changed. Liquidity is no longer abundant. Credit is no longer cheap. Tolerance for error is gone. The system has shifted from expansion to selection, and selection is never gentle. This is the phase where comforting beliefs do the most damage. This time is different. The system has safeguards. Central banks will step in. Technology has changed the rules. History has already answered every one of these claims. Empires believe them. Markets believe them. Citizens believe them. None were spared by belief. Late cycle systems do not collapse because people panic. They collapse because they are too optimized to absorb stress. Small disruptions cascade. Minor failures propagate. Confidence evaporates faster than liquidity can be injected. And when confidence breaks, pricing changes instantly. Not gradually. Not politely. This is why the danger period is never marked by a date. It is a window. A window where leverage is high, reserves are thin, and expectations assume continuity. Inside that window, the order of failure is consistent. Markets destabilize first not through crashes, but through illiquidity. Prices gap. Volatility spikes. Correlations converge. Then credit contracts. Lending standards tighten abruptly. Refinancing becomes difficult. Defaults rise not because businesses suddenly fail, but because rollover fails. Then currencies weaken. Capital seeks safety. Trade imbalances surface. Import costs rise. Living standards quietly adjust downward. Finally, supply chain strain. Not everywhere. Not evenly. But enough to change behavior. This is the sequence. It has repeated across centuries, continents, and systems. And the most important truth is this. Most people experience this phase without understanding it. They do not see collapse. They see inconvenience. They see volatility. They see uncertainty. They adjust slowly while the system adjusts instantly. Those who are prepared do not escape consequences. They experience less irreversible damage. Those who are unprepared lose time, flexibility, and options often permanently. This is not because they lacked intelligence. It is because the system does not reward awareness alone. It rewards alignment with reality. And reality at this stage is unforgiving. The world does not end at the close of a cycle. But the rules change. Returns compress. Risk is repriced. Stability becomes conditional. What worked before stops working not because it was wrong, but because the environment no longer supports it. This is the hardest transition for people to accept. They anchor to the past. They assume continuity. They wait for confirmation. But confirmation always arrives after damage. That is why this phase feels unfair. Because those who move early appear cautious until they appear correct. And those who wait appear rational until they appear exposed. This is not a moral judgment. It is mechanical. Systems do not care about fairness. They care about balance. And balance is restored through pressure. History does not punish participation. It punishes misalignment. At this point in the cycle, responsibility shifts. Not to governments. Not to institutions. Not to experts. To individuals. Not responsibility for outcomes, but responsibility for awareness. Because no system in history has protected those who refuse to see its limits. The late stage always rewards vigilance over optimism. Not because optimism is wrong, but because it is insufficient. The uncomfortable reality is this. By the time the final stage is obvious, positioning is no longer possible. Options disappear. Liquidity vanishes. Choices narrow. This is why awareness must come before certainty. History has already answered the question of what happens next. It always does. The only variable left is who understands the sequence while movement is still possible, and who learns it after the fact. The system will continue. Markets will continue. Life will continue. But the environment will not remain forgiving. And those who assume it will are not betting on strength. They are betting on delay. Delay has never been a winning strategy at the end of a cycle. The final pages of every financial era are written quietly, not with announcements, not with warnings, but with repositioning. That repositioning is already visible to those who know how to read it. The pattern is no longer forming. It is completing, and history has already decided how this stage ends. The only unanswered question is who understands it before it finishes. Part 2 will examine what breaks first and why it always does.